Okay, today we're going to tackle Chapter 1, Section 2 on how business activities change the accounting equation. So, I'm going to teach you the accounting equation. It's super tough, so make sure you're ready for it. So, paying attention, here we go. So remember that we are going to have a business called Delgado Web Services, and we're going to work with this business through all of our work togethers from Chapter 1 all the way up to Chapter 8. And Delgado Web Services is a service business, which means that they perform an activity for a fee, meaning that people don't actually get a product from them. Instead, there's some sort of a service. So whether they're doing landscaping at their house, or you're getting your hair done, or you're babysitting, or you go to the doctor, to the dentist, those are all examples of service businesses. Delgado Web Services is also a proprietorship, which means that the business is owned by one person. Oftentimes you might hear it referred to as a sole proprietorship. Sole just means one. And what this means is that the owner is legally responsible for all the debts, taxes, and losses. We call that unlimited liability. So they are essentially responsible for everything, whether the business is doing awesome or whether the business is really struggling. The one main advantage of doing a sole proprietorship is that the owner is going to receive all of the profits. So that's the major plus. The major negative is obviously that unlimited liability. So the first step that needs to happen when you start a business is that you need to write a business plan. And a business plan is simply a formal written document that's going to describe the nature of a business and also how it's going to operate. You can have a very detailed business plan, or you can have, something that's much more simple. It just depends on the nature of your business. So when it comes to accounting, we have something referred to as GAAP. Or generally accepted accounting principles. And what those are their standards and rules that all of the accountants follow regarding recording and reporting of our financial activities. Now, the reason this is so important is it ensures something called consistent reporting, which just means that if you look at the financial statements of one company and compare them to another, you should be able to do some comparing because everything is reported in the same way. That's what consistent reporting means. So when we do accounting, we follow GAAP, or generally accepted accounting principles. No, not like the Gap in the store. You're missing, we have an extra A in our accounting one. A couple of accounting concepts we want to talk about is unit of measurement. What that means is that we use numbers that have comparable values. Obviously, we work in dollars and cents when we're talking about accounting, so that just means that we're not comparing, pesos or yens or euros. We're doing ours in dollars. And then we also have business entity, which simply means that a business's financial information gets recorded and reported separately from the owner's personal financial information. So, for example, if I owned a dog walking business, I would keep my dog walking business separate from my personal checking and savings account. That's what we call a business entity. So, back to the accounting equation. From section 1.1, we've already talked about assets and liabilities, meaning things that we own and things that we owe to other people. Now, the difference between those we call equities, or financial rights to the assets of a business. The amount that's remaining after the value of liabilities gets subtracted from the value of assets is called owner's equity. Okay, and so what the accounting equation shows essentially is assets, liabilities, and owner's equity. So are you ready for this intense equation I was telling you about? Here it is. Assets equals liabilities plus owner's equity. So it's super simple, actually. So just kidding if you were really getting freaked out about a super complex equation. Assets equals liabilities plus owner's equity. That is the foundation of accounting. So you have to have that down. You have to get that straight. And so we have it in what we call a T account, and we're going to look at T accounts in chapter 2. But essentially what this has is that, assets are on the left side of our accounting equation, and they equal our liabilities plus our owner's equity, which is on the right side of the equation. Okay, so What we're going to have here is a few things. We're going to start looking at some transactions. So anytime that a business activity changes assets, liabilities, or owner's equity, we call that a transaction. Okay. So we are going to have what we call accounts, which are just records that summarize all of the transactions that pertain to a single item. So remember, the single item in the accounting equations were assets, liabilities, and owner's equity. Okay. So each of those is going to have an account title, which is simply the name that gets given to the account. And then we also have the account balance, which is the difference between when it increases and when it decreases. Okay, and then we also have something called the capital account, which is an account that's going to be used to summarize the owner's equity. Okay, so we call that the capital account. So if we have a transaction on January 2nd that says we received cash from the owner as an investment for $2,000, we need to talk about how does that affect our accounting equation. So what that looks like is if we started out with all of our beginning balances here, we have our assets. Cash is an asset because cash is something that we own. And then owner's equity, remember we said that the account that we have for owner's equity is called capital. So remember Michael Delgado is our owner of Delgado Web Services, and so we have his capital account here. So what happens is at the beginning of the month, everything is at a zero balance. Okay. Then on January 2nd, what happens is we receive $2,000 in cash. So cash is going up. And then what happens is the owner's capital account also goes up by that same amount. And the reason we can do that is if you notice this equal sign and the line that runs down the middle, we can do that because there's $2,000 on the assets, and that equals 0 plus the $2,000 in the capital account. So 2,000 and 2,000 equal, we're happy. We always come back to, does our accounting equation equal? And if it doesn't, then something happened and we did something wrong. Okay, so now if we're paying cash, it says on January 2nd, we paid cash for supplies for $165. So I'm going to pull up our accounting equation again here. Okay, this is talking about this one right here. So remember, we just had $2,000 in cash come in, and we have $2,000 in our capital account. Now, when we pay cash for supplies, our cash is going to go down by $165. That makes sense. If you pay for something, your cash is going down. Now, supplies is also an asset because if you think about it, if you own supplies, it's something that you own, so we call that an asset. So supplies is actually going to go up by $165. Now, we can do this because cash and supplies, even though we're going down and going up, we can do that because we're on the same side of the accounting equation. So if you look down here to our new balances, we have $1,835 plus $165, and if you add those two together, you get $2,000, and that still equals our capital amount over here. So we're good. Now it says on January 3rd, we also paid cash for insurance for $900. So that's talking about this one right here. And so because we paid cash, cash is going down by $900. It's pretty straightforward with accountants. We don't like to add a lot of sneaky words. So literally when it says paid cash, cash goes down. If you receive cash, cash goes up. Okay, now let's talk about insurance for a second. If you understand how insurance works, you know that you pay up front for coverage, and then once you pay that $900, they're either covered for 6 months or a year. We don't know that specifically, but since you prepay that and you're covered, we consider that to be an asset. So this is going to work the same way that our supplies did, in that our cash is going to go down, but our insurance is going to go up. So now we have our new balances are $935 in cash, $165 in supplies, and a prepaid insurance of $900. If you add those all together, they still equal $2,000, So our accounting equation is in balance and we're happy. Now we also have transactions on account, meaning that there are times where someone doesn't pay for something right away. We call that a liability. And we owe someone something, so we call that a creditor. So here, for example, on January 5th, we bought supplies on account from Canyon Office Supplies for $220. So remember, if it doesn't say anything about cash, cash is not going to be affected. So when we look at this here, what's happening is that we bought supplies, so supplies are going up. Remember, supplies are an asset, so that's over here under the asset column. However, we did not pay for our supplies yet, which means that we now owe somebody money, and that person happens to be Canyon Office Supplies. So we're going to put our accounts payable, which means a liability. We owe them money. That's also going to go up by $220. So now if we do our new balances, we've got $935, $385, $900, and that is going to equal $220 plus the $2,000. So if you get your handy dandy calculators out, it's going to show you that. Okay. Our last transaction here is on January 9th. We paid cash on account to Canyon Office Supplies. So what we're doing here is we are paying down the amount that we owe people. So again, paid cash means that we go over here to our cash account. Cash is going down by $100. And now the amount that we owe Canyon Office Supplies is also going down by $100. So you can see we go from $220 down to $120. Okay. And same thing over here, our cash is going down by $935 to $835. So notice that if you are on opposite sides of the equal sign, your sign, whether it's a plus or minus, it should be the same. You couldn't have a minus over here and a plus 100 over here because then you wouldn't be equal. Okay. If you're on the same side, like when we were talking about cash and supplies or cash and prepaid insurance, they can be opposite because they're going to equal each other out. Okay. So I know it's kind of a lot to take in, but this is kind of where we're going to start working with our accounting equation. So we're going to start next. We're going to do the work together, 1, 2 on our together here, and that should hopefully kind of help clear up any questions you might still have.